Welcome to the deep dive. Today, we are cutting through the noise on gold, XAUUSD, with a really urgent deep dive. We're focused entirely on the immediate pressing market risks.
That's right.
It's late in November 2025, and we're seeing signs of, well, extreme sensitivity and volatility. And for you, the U.S. investor and trader, this is critical stuff for managing your exposure right now.
It is. The reality of the moment is we are standing at a major tension point in the gold market. I mean, the price action is basically split.
Split between what?
Between an immediate high-risk scenario where profit-taking could be violent and those extremely aggressive long-term bullish forecasts. We're unpacking the sentiment as of today, November 24, 2025, using the latest expert insights.
And our mission here is laser-focused. We are trying to extract the urgent truth about what drives gold today.
Right now.
So we're looking at critical economic data, the massive shadow cast by the Federal Reserve, and specifically why a respected voice like Kathy Lyon is calling gold a crowded trade.
And that term, that's not just jargon.
No, it's a flashing red light for downside risk.
And that's precisely where we have to begin. We need to focus on what crowded means for your immediate risk and, how quickly liquidity can just vanish in a leveraged environment.
Okay, let's unpack this core idea immediately. When Lyon calls gold a crowded trade, for our audience of U.S. traders, we need to go beyond the simple definition. What are the specific risk mechanics at play? And why is this warning popping up right now in the run-up to the holiday season, of all things?
Well, when analysts call a trade crowded, it's a warning about the market structure, not just its price. It means too many people are on the same side of the boat, the long side, often using leverage.
So it's not just popular, it's dangerously one-sided.
Exactly. It implies a massive margin debt overhang.
Yeah.
So if the price dips even a little bit, you get these forced liquidation cascades. Traders have to get out all at once.
And there's no one on the other side to buy.
There's just not enough buyers left to absorb all that selling. So the technical support levels, they don't bend. They break instantly.
Okay, so we have an inherently unstable, leveraged environment. But here's where it gets really interesting and, frankly, a bit counterintuitive.
Yeah.
Why would a major commodity, a geopolitical shield, suddenly become so dependent on something as boring as how many gift cards people are buying?
You have to connect it to the bigger immediate picture.
Right.
The U.S. economy and what the Fed is thinking, in the short term. The pivot point here is this extreme sensitivity to holiday shopping data.
From places like the National Retail Federation?
Precisely. If we see robust consumer data from the National Retail Federation, for example, that signals a resilient, strong consumer.
And a resilient consumer means the domestic economy isn't faltering, right?
Exactly. A strong NRF report showing high spending, strong online sales. It immediately eases the pressure on the Federal Reserve to start easing policy.
Because the market has been pricing in rate cuts for next year.
It has. But if the consumer is healthy, the Fed can keep rates higher for longer.
Which is bad news for gold.
Terrible news for gold. It's a non-yielding asset. If the U.S. economy can handle high rates, the opportunity cost of holding gold just skyrockets.
Yeah.
Investors will run towards anything with a yield.
So the fact that gold is now watching holiday spending so closely.
It just shows you how exposed and reactive this crowded trade has become.
Yeah.
A strong shopping report could be the immediate catalyst that unwinds this whole thing.
So the market is currently obsessed with gift receipts and retail data. But let's zoom back out, because beneath all that holiday noise, the biggest shadow in the market is always the Federal Reserve.
Always.
Our sources confirm the usual macro drivers are still looming large and could amplify this volatility. We're talking, of course, about the Federal Reserve, the U.S. dollar, and everyone's favorite tool, the CME FedWatch tool. What does this foundational trio mean for the immediate risk in a trade that's already crowded?
Well, that's the critical point. In a market where positioning is already stretched to the limit, where everyone is leveraged and jumpy, any perceived shift in these macro factors will trigger a sharp, disproportionate correction.
So let's break down the mechanics. How does the market track what the Fed is going to do?
Well, the market is always trying to price in what the Fed will do next. And the CME FedWatch tool is basically the scoreboard that U.S. investors use to see those probabilities in real time.
And any hawkish signal pushes those probabilities up.
Right. A strong jobs report, a strong NRF figure, anything that suggests the economy is hot pushes up the odds of higher for longer rates. And that has immediate consequences for gold.
Okay, first, opportunity cost.
Correct. When interest rates are high, holding gold, which pays you zero, becomes very expensive. It pushes traders to sell and move into assets that actually yield something.
Then second.
Second, those hawkish Fed signals strengthen the U.S. dollar because capital flows toward those higher-yielding dollar assets.
And since gold is globally priced in U.S. dollars, a stronger dollar is a direct headwind.
That's the other half of the puzzle, exactly. When the dollar index strengthens, gold gets more expensive for everyone outside the U.S., which kills demand.
So what happens then?
Well, what you see is often an accelerated technical breakdown. The market is forced to test major support levels because, for millions of traders, the reason for holding gold just flipped negative all at once.
So you combine a strong Fed, a strong dollar, and this crowded positioning.
And you have the perfect recipe for a swift, punishing sell-off.
We have to establish context for just how turbulent this market has been recently. I mean, let's be clear. This November warning isn't happening in a vacuum. We just have to rewind a few weeks to October to really understand how shaky the ground is that this crowded trade is sitting on.
Oh, absolutely. We must look back at October 2025 to get the full picture of this fragile foundation. That whole period was just marked by serious, intense distress signals.
What specifically happened in mid to late October that set the stage?
It was a confluence of really serious warnings. First, we saw an ex-Fed insider explicitly warn of the systemic liquidity crisis.
Wow, that's a strong term.
It is. This wasn't hyperbole. This person was seeing the gold sell-off not as a simple correction, but as a major distress signal that pointed to wider strain in the whole market.
When we talk about a liquidity crisis in this context, what does that mean practically for a trader trying to get an order through?
It means your execution risk goes through the roof. When liquidity dries up, the space between the bid and the ask price widens dramatically. You can't execute large orders.
So even small sell orders can move the market.
They can send prices sharply lower. You get what's called gapping, where the price literally jumps past the support levels you were watching. That October warning was about this risk, that the market structure itself was fragile.
And the physical price action confirmed that fragility, that panic?
It did. Gold and silver saw their worst one-day drop in years right around that same time, which confirmed there was immense violent selling pressure. It showed how fast bullish sentiment could just flip to outright panic.
And this was so acute that experts were actively signaling it was time to exit, not to get in.
Precisely. Market experts were telling investors to take profits on gold and silver during that period. That's not minor advice. That shows professional sentiment had turned decidedly bearish.
So just weeks after that, new buyers have rushed in so fast that it's now called crowded again.
Which just proves how reactive and fundamentally unstable this market is.
This confirms the crowded trade is built on a very shaky foundation, where traders are just ready to bolt at the first sign of weakness.
Whether that weakness comes from the Fed or the National Retail Federation.
Well, we see these urgent, severe warnings about crowded trades and volatility. We absolutely cannot ignore the persistent, powerful counter-narrative. I mean, we saw predictions earlier in 2025 that paint an entirely different future for gold, a future that goes way beyond next quarter's retail data.
And this is the core of the investor dilemma. It demands some critical thinking. While the short term is all about these tactical moves, Fed policy, the dollar, the strategic, the generational view, remains overwhelmingly bullish.
And these two timelines are now in direct conflict.
Dramatic direct conflict.
And the numbers being cited for that long-term potential aren't just ambitious, they are absolutely staggering.
They are. Earlier this year, for instance, we saw analysis suggesting that if history rhymes, if gold goes to a fundamental generational revaluation, prices could potentially hit $25,000 to $55,000.
$55,000.
Yes. And this isn't just a wild guess. This thesis is based on historical analogies, like the relationship between money supply and gold reserves back in the 1970s. The argument is that current global debt loads demand a much higher real value for gold.
That $55,000 number is almost impossible to process when you're watching the price tick down because of a retail sales report.
Of course.
So do you feel like those long-term strategists are even paying attention to the day-to-day noise?
That's a great question. And I think it's less about ignoring the noise and more about understanding different scales of risk. The people projecting $55,000 aren't worried about a 5% drop next week.
They're not trading it.
No. They're looking at the ultimate risk of monetary debasement over the next decade. Their focus is strategic. The short-term warnings about a crowded trade are for the tactical trader, warning them about the traps on the way to that potential high price.
So what does this dramatic conflict mean for you, the listener? We have this urgent, immediate risk, but also this potentially massive upside if that historical revaluation happens.
It means you have to define your time horizon and be very clear about it. You have to constantly weigh the immediate tactical advice, the warning that gold is crowded against that strategic generational trend towards revaluation.
And this headline, on November 24th, it confirms that no matter what you think the price will be in 10 years.
Your immediate risk exposure is extremely high and needs to be managed, or you could be forced out of your position way before that long-term trend ever plays out.
So the market is demanding you make a choice. Manage the volatility or ignore the noise and bet entirely on the generational payoff.
That's the choice.
Okay, we've successfully distilled the immediate risk factors in the gold market. It's being called a crowded trade, making it highly sensitive to U.S. economic data like holiday shopping figures. And it remains caught squarely between the Fed's monetary policy and its own recent history of extreme volatility.
And the key takeaway here is the urgency of this moment for U.S. traders. The convergence of all these forces, the U.S. economy, the dollar, the Fed, it's creating a knife's edge situation.
Where any deviation from expectations could trigger a sharp correction.
Exactly, the kind of correction you expect from a heavily leveraged and crowded trade.
So given the powerful warnings of near-term liquidity stress and this intense short-term volatility,
How much short-term risk should an investor tolerate and actively manage when you're faced with the potential reward of revaluation charts projecting prices up to $55,000?
that's the strategic decision you have to make right now, balancing tactical survival with that generational strategy. Thanks for joining us for this urgent deep dive.